Hi traders, it's Matt here. Today's lesson is all about analysis and defining the 3 telltale signs of a stock market crash. So what I'm going to cover today is what is the difference between a crash and a correction. We'll quickly go over that one as I have other lessons on that. We'll also discuss key facts that you need to know first, and then discuss the 3 telltale signs that will help you identify if a stock market crash is just around the corner. After that, I'm going to just sum it up with the phrase, embrace the inevitable. A crash will occur. They've occurred in the past. They will occur in the future, and you need to embrace that. So let's get stuck into the lesson. So first of all, is it a crash or is it a correction? Let's just define what is the difference between the two. A correction is a realignment back to the median, whereas a crash is a fall that occurs quickly, without warning, and is driven by panic. What we'll do is take a quick look at our charting software and have a look at 2 different scenarios of a correction and of a crash. So here I have the S&P 500 index up in front of us. Now this is a long-term chart. We have weekly candlesticks, so each one of these candlesticks represents 1 week, and we are looking back to the global financial crisis of 2007-2008. The top of the market was really in the middle to late 2007. We can see these highs up through here, just above 1,550 points. If I put a horizontal line in there, we can see that was the peak of the market. The actual crash occurred in October of 2008. And this is this period just through here, these 2 very large bars right in the middle of the chart. We can see here, and if I put a horizontal line just above the top of where that crash occurred, the market had been declining for the months prior to the actual crash. An estimate of that is approximately 22%. Once the crash occurred, there was still some continued downwards momentum following that. However, the bottom of the market was in March of 2009. So following the crash, there was a further 44% or so, 42% of downwards movement in the markets. In total, we had more than a 50% decline in the markets, nearly 57% there. So the crash itself was not at the top of the market, and that's an extremely important point to help defining whether a crash is likely to occur, and we'll cover that shortly. Let's compare that to a market correction, and there was one of these occurred recently in January of 2008. We can see this market here pushing higher. There was a correction back to our 50 and 100 period moving average levels, which are denote our medium to long-term trend, and then the markets started to recover. So this is what we refer to as a correction. A correction will be anywhere up to about 10% and will normally come from a high where the markets have become overbought. And we can denote that as being overbought because of the amount of distance between where the market is trading and its medium-term to long-term moving averages. So our first telltale sign for identifying whether a stock market crash is just around the corner is to identify whether there has been a change in the primary trend. As we just saw, a market correction is a normal movement, just realigning the markets back to their medium. Whereas a stock market crash is something where there's a very quick movement with panic in behind it. See, crashes rarely occur at the top of a bull market. So establish the primary trend. If it's upwards, then there's little probability of a stock market crash. Identify a change in trend, and then you will adjust your strategy management accordingly. Telltale sign number 2 is what is the displacement that causes a crash. So the economist Hyman Minsky had defined that a crisis or a crash has to start with a displacement, a trigger or a reason to shock the macroeconomic environment. Without a cause, there is no reason. Nearly every single stock market crash that we have seen has had a cause. We might not know what that cause is until shortly thereafter, and other times we do know what the cause is. For the global financial crisis of 2008, we knew the cause of the stock market crash. Subprime information had already been out in the markets since mid-2007, and that was the trigger for the bear market, or a change in the primary trend. So once we've identified there's a change in the primary trend, we can identify that there is a displacement or a trigger to cause that market to start to panic. We can then consider telltale sign number 3. You need to learn to read and listen to market sentiment. Are there signs of investor fear or greed? What is the smart money doing? When we refer to smart money, we're talking about investment money by large investment funds. They are going to move long before you and I start to move. They are the ones that cause the markets to start to change. And another aspect of listening to market sentiment is identifying whether everyone is talking about making money in the markets. We have this terminology now, FOMO, the fear of missing out. And what happens is that everybody will start getting into the markets. All the mum and dad investors, the home investors will start getting into the markets because they don't want to miss out. At that point in time, that's usually the exhaustive movement of trading. So with those 3 telltale signs behind you, if they all start to align, there is a higher probability that a stock market crash will occur. Embrace the inevitable. As I said at the very beginning, crashes have occurred in the past and they will occur again in the future. By identifying the difference between whether it's a correction or a crash, you will have a better opportunity of saving your money that's in the markets and aligning yourself for new opportunities. But remember, stock market crashes are far and few between. Since 1945, we have only had 5 stock market crashes where we have seen a decline of 50% or more. A stock market correction is far more likely to occur. Approximately every year or so, there is at least one 10% decline to realign the markets. But in those scenarios, the broader primary trend continues. So establish a course of action for when your telltale signs, those signals, start to align. Having such a course of action behind you means that you shouldn't fear what could happen in the markets. So don't fear what can happen, trade with what you know. That sums up our lesson today on the 3 telltale signs of when a stock market crash is about to occur. Thanks for listening, and I wish you all the best in the markets.